Cryptocurrency has transformed the financial landscape, sparking curiosity and debate across the globe. As digital assets like Bitcoin and Ethereum gain traction, people from all walks of life, investors, tech enthusiasts, and casual observers, are eager to understand this innovative space. Questions abound about how these currencies work, their value, risks, and potential to reshape economies. The decentralized nature of cryptocurrencies, powered by blockchain technology, challenges traditional systems, making it a topic ripe for exploration. With the market's volatility and the promise of high rewards, it's no surprise that inquiries range from basic definitions to complex regulatory concerns. This piece dives into the most pressing queries people have, offering clarity on a subject that often feels shrouded in mystery. Whether you're a beginner wondering about the basics or someone seeking deeper insights into mining or taxation, these responses aim to illuminate the essentials. The goal is to provide a foundation for understanding, cutting through jargon, and hype to deliver straightforward explanations. By addressing these common curiosities, we hope to equip readers with the knowledge to navigate the ever-evolving world of digital currencies. Let's embark on this journey to unravel the top questions that dominate conversations about cryptocurrency today, shedding light on its mechanics, implications, and future. 1. What is cryptocurrency, and how does it work? The term cryptocurrency buzzes around in conversations, news headlines, and social media, but what exactly does it mean? Many people hear about Bitcoin or Ethereum and wonder how these digital entities differ from the cash in their wallets. Unlike traditional money issued by governments, cryptocurrencies operate without a central authority, which can feel both liberating and confusing. They rely on something called blockchain, a word that often pops up alongside crypto. But how does that fit into the picture? People want to know how you can trust a system that's not overseen by banks or regulators. Is it just digital code floating in cyberspace, or is there more to it? The mechanics of sending and receiving crypto also raise eyebrows. How can you pay someone without a middleman? This question stems from a mix of intrigue and skepticism about a currency that exists only online. For beginners, it's a gateway to understanding why crypto has captured global attention. The idea of cryptographic security adds another layer. It's not just about digits, but about protecting transactions in a way that's hard to hack. As adoption grows with businesses accepting crypto payments, the curiosity deepens. How does this invisible money actually function in the real world? Unpacking this lays the groundwork for grasping the broader crypto ecosystem. Cryptocurrency is a digital or virtual currency that uses cryptography for security and operates on a decentralized network, typically a blockchain. Unlike traditional money, it's not issued by governments or banks, but is managed by a distributed ledger across many computers. Blockchain records all transactions transparently and immutably, ensuring trust without a central authority. When you send crypto, like Bitcoin, you use a private key to sign the transaction, which is verified by network participants called miners or validators using complex math. Once confirmed, it's added to the blockchain, making it permanent. This process eliminates intermediaries, cutting costs and delays. For example, Bitcoin relies on proof of work, where miners solve puzzles to validate transactions and earn rewards, while Ethereum uses proof of stake, where validators stake coins to process transactions. You store crypto in digital wallets, which hold your public and private keys. Think of the public key as an address, and the private key as a password. Transactions are pseudonymous, showing addresses but not names, enhancing privacy. Businesses accept crypto by integrating wallet systems, converting it to cash if needed. Its value comes from supply, demand, and utility, not government backing. This decentralized, secure system is what makes cryptocurrency revolutionary, though it requires understanding its tech foundation to fully appreciate it. 2. How can I buy cryptocurrency? Buying cryptocurrency is a hot topic as more people dip their toes into this digital frontier. The process can seem daunting. Where do you even start when there's no physical bank to visit? With stories of Bitcoin, millionaires and market booms, the urge to join in is strong, but the how-to remains elusive for many. Do you need a special account, or can you use your regular credit card? Platforms like Coinbase or Binance pop up in searches, but what's the safest way to proceed? People worry about scams, fees, and whether they'll lose their money before they even own any crypto. The idea of wallets, digital ones, not leather, adds another twist. Do you need one right away, or does the exchange handle that? Then there's the question of which cryptocurrency to buy. Bitcoin's the big name, but what about others? Timing also nags at potential buyers. Is now a good moment, or should they wait for a dip? This question reflects both excitement and caution, as newcomers seek a clear path into a market that promises opportunity but feels like uncharted territory. It's about taking that first step without tripping over technical hurdles. To buy cryptocurrency, start by choosing a reputable exchange like Coinbase, Binance, or Kraken, which act as online marketplaces. Sign up with your email, verify your identity, usually with ID, and link a payment method. Credit cards, bank transfers, or even PayPal work on many platforms. Fees vary, so check. Card payments often cost more, around 2 to 4%, than bank transfers, sometimes free. Once funded, pick your crypto. Bitcoin and Ethereum are popular starters, and place a buy order at the current market price or a set limit. The exchange converts your cash to crypto instantly. Next, consider a wallet. Exchanges store your coins, but moving them to a personal wallet, software like Exodus or hardware like Ledger, boosts security. Exchanges can be hacked, so don't leave large amounts there long-term. Research the coin's purpose and market trends before buying. Prices swing wildly, so timing matters but isn't predictable. Start small to test the waters, avoiding scams, by sticking to well-known platforms. After purchase, you'll see your balance in the exchange or wallet, ready to hold, trade, or spend. It's straightforward once you pick a trusted entry point and prioritize safety. 3. Why is cryptocurrency so volatile? Cryptocurrency's wild price swings leave people scratching their heads. Why does Bitcoin soar to $60,000 one month and crash below $30,000 the next? Traditional stocks fluctuate too, but crypto's roller coaster feels extreme, sparking questions about what drives this chaos. Is it just hype, or are deeper forces at play? News of bans, hacks, or celebrity tweets can send markets spinning, but how much do these matter? Some point to the lack of regulation. Without a government anchor, is crypto just a free-for-all? Others wonder if its small market size compared to stocks amplifies every move. The role of supply and demand pops up too. With Bitcoin capped at 21 million coins, does scarcity fuel the frenzy? Investors want to know if this volatility is a flaw or a feature. Can it settle down, or is it here to stay? This question ties to risk and reward, as big gains tempt but big drops terrify. Understanding the why behind these shifts is key for anyone eyeing crypto as an investment or a future currency. Cryptocurrency's volatility stems from several factors blending into a perfect storm. First, it's a young, unregulated market. Unlike stocks, no central authority stabilizes prices, leaving it open to rapid sentiment shifts. Supply and demand rule. Bitcoin's fixed 21 million coin cap means scarcity spikes prices when demand surges, but panic selling can tank it fast. Low liquidity compared to traditional markets amplifies this. Fewer coins traded means big buys, or sells move the needle more. News plays a huge role. A country banning crypto or a Musk tweet can trigger mass reactions as traders overreact to headlines. Speculation dominates too. Many buy hoping for quick profits, not long-term use, fueling bubbles and busts. Market manipulation, like pump-and-dump schemes, adds chaos in this less policed space. Adoption swings also factor in. Rising merchant use boosts value, but setbacks reverse it. Over time, as crypto matures and liquidity grows, volatility might ease, but for now, it's a high-stakes game of psychology, scarcity, and external shocks. 4. Is cryptocurrency legal? The legality of cryptocurrency is a puzzle for many, as headlines clash. Some countries embrace it, others ban it outright. Can you use Bitcoin freely in the US, or are there hidden catches? People hear about Salvador making it legal tender, then China cracking down, and wonder where the lines are drawn. Does owning crypto risk breaking laws, or is it just trading that's tricky? Taxation adds another wrinkle. Governments want to cut, but how does that work with digital coins? The decentralized vibe of crypto feels rebellious, so folks question if it's too wild for regulators to handle. Are exchanges legit, or could they get shut down? This question matters to anyone holding or eyeing crypto, as legal status shapes its practicality and safety. It's not just about today, but the future. Will laws tighten as crypto grows? Clarity here separates fear from informed action. Cryptocurrency's legality varies by country, but it's broadly legal with rules. In the US, it's allowed. You can buy, sell, and hold it. But the IRS taxes it as property, so capital gains apply, e.g. 15 to 20% on profits if held over a year. Trading's fine on registered exchanges like Coinbase, which follow anti-money laundering laws. El Salvador made Bitcoin legal tender in 2021, letting citizens pay taxes with it, while China banned trading and mining in 2022, citing financial risks. Most nations fall between. The EU regulates exchanges for transparency, not banning crypto itself. Japan treats it as legal property with strict oversight. Illegal uses, like funding crime, get targeted, not the tech. Exchanges can operate if compliant, but unregulated ones risk shutdowns. Laws evolve as crypto grows. Future clampdowns could hit mining or stablecoins, but outright bans are rare in open economies. Check your local rules. Legality's clear. Where regulated, murky where not. 5. How is cryptocurrency mined? Mining cryptocurrency sounds exotic. Visions of digital pickaxes digging for virtual gold. But what does it mean? People know Bitcoin miners earn coins, but how do computers mine something intangible? Is it just running software? Or do you need fancy gear? The energy use tied to mining raises eyebrows, too. Why does it guzzle so much power? Some hear about solving puzzles, but what's the point, and who sets them? This process underpins crypto's security, yet it's a black box to most. Can anyone mine, or is it just for tech wizards? With Ethereum shifting away from mining, does that change the game? This question taps into crypto's tech core, revealing how new coins enter circulation and why it's not as simple as printing money. It's a mix of fascination and practicality for those curious about the engine behind the blockchain. Cryptocurrency mining is how some networks, like Bitcoin, create new coins and verify transactions. Miners use powerful computers to solve complex mathematical puzzles. Think of them as locks on the blockchain. When solved, a miner adds a block of transactions to the chain and earns a reward, e.g., 6.25 BTC now. This proof-of-work system secures the network by making tampering costly. You need specialized hardware like ASICs, not just a laptop, because the puzzles demand huge computing power, hence the energy hog, rivaling small countries' usage. Anyone can mine, but profitability requires cheap electricity and high-end gear. Solo miners often join pools to share rewards. The puzzles adjust in difficulty to keep blocks coming every 10 minutes for Bitcoin. Ethereum ditched mining for proof of stake. In 2022, where validators stake coins instead, slashing energy use. Mining's role is to decentralize and secure, but it's a race. First to solve and win. Others get nothing. 6. What are the risks of investing in cryptocurrency? Investing in cryptocurrency tempts with tales of overnight wealth, but the risks loom large. Why do so many warn about losing it all? Prices can plummet 50% in days, unlike stocks gentler. Dips, making hearts race. Is it just volatility, or are there darker pitfalls like hacks and scams? People hear about wallets being drained or exchanges collapsing. How common is that? Regulatory uncertainty adds dread. Could a government ban? Wipe out your holdings? Then there's the tech itself. Lose your private key and your money's gone forever. Newbies wonder if it's a bubble, propped up by hype, or a solid bet. This question weighs reward against ruin, as crypto's allure battles its chaos. Understanding the dangers is crucial before jumping in. Investing in cryptocurrency carries big risks. Volatility tops the list. Prices swing wildly due to speculation, news, or whale trades, unlike stocks with more stability. Hacks hit hard. Exchanges like Mt. Gox lost millions, and personal wallets are targets if unsecured. Scams thrive, fake. ICOs and Ponzi schemes prey on greed. Regulations are a wild card. Bans, e.g. China, or tax hikes could tank values overnight. Tech risks bite too. Lose your private key and your crypto's unrecoverable? No bank to call. Liquidity varies. Smaller coins can trap you if no one's buying. Market manipulation, like pump and dumps, distorts prices. It's not all a bubble, but hype inflates some coins beyond their worth. Diversify, research, and only risk what you can lose. High rewards come with high stakes. 7. How does blockchain relate to cryptocurrency? Blockchain and cryptocurrency are joined at the hip, but how exactly? People toss around blockchain as crypto's backbone, yet the link confuses many. Is it just a fancy database, or does it do more? Without it, would Bitcoin even exist? The idea of a tamper-proof ledger sounds cool, but how does that turn into money? Some know it's decentralized, no single boss, but how does that keep crypto running? Others ask if blockchain has uses beyond coins, like tracking goods. This question bridges tech and finance as folks seek to grasp why this duo matters. It's about peeling back the layers of a system that's reshaping trust online. Blockchain is the tech foundation for most cryptocurrencies, acting as a decentralized, secure ledger. It records every transaction in blocks, linked chronologically and locked with cryptography. Think of it as a digital chain no one can alter solo. For Bitcoin, it logs who sends what, verified by miners, ensuring no double spending without a bank. Crypto wouldn't work without it. Central ledgers need trust, but blockchain distributes trust across a network. Each computer, node, holds a copy, so hacking one doesn't break the system. Majority consensus rules. Beyond crypto, it tracks supply chains, votes, or contracts, but its fame comes from enabling digital cash. It's the engine, crypto's the fuel. 8. Why do some governments ban cryptocurrency? Governments banning cryptocurrency, like China's harsh stance, baffles many. Why fear a digital coin? Some say it's about control. Crypto slips past central banks, letting people move money freely. Does it threaten economies or just old power structures? Crime worries pop up too. Can it really fund terrorists or launder cash that easily? Others point to volatility. If citizens lose big, who picks up the pieces? Energy-hungry mining irks eco-conscious leaders too. Yet places like El Salvador embrace it. Why the split? This question digs into politics and money's future, as bans signal deeper tensions between innovation and authority. Governments ban cryptocurrency for control, crime, and stability fears. It bypasses central banks, weakening monetary policy. China hates that, wanting yuan dominance. Criminals use it for laundering or dark web deals. Though blockchain is traceable, bans aim to curb this shadow economy. Volatility scares regulators. If citizens lose savings, economic chaos could follow with no safety net. Mining's energy drain, like Bitcoin's grid-straining appetite, clashes with green goals. Some, like El Salvador, adopt it to dodge dollar. Reliance or boost inclusion. Bans reflect a tug of war. Protect the system or squash a rival. Fear of losing grip drives the harshest moves. 9. Can cryptocurrency replace traditional money? Could cryptocurrency ever oust dollars and euros? It's a dreamy or dystopian thought for many. Bitcoin's borderless, bank-free appeal hints at a future where cash feels outdated, but is that realistic? People wonder if it's stable enough to buy groceries or pay rent. Those price swings don't scream reliability. What about mass adoption? Will grandma ever ditch her checkbook? For a wallet app? Governments won't just step aside. They love controlling money. Yet crypto's speed and low fees tempt, especially in global trade. This question probes if digital coins are a gimmick or a revolution poised to rewrite finance. Cryptocurrency replacing traditional money is possible, but tricky. It's fast, cheap for cross-border use, and cuts out banks, appealing in a digital age. Bitcoin's fixed supply could dodge inflation, unlike fiat cash, but volatility kills everyday trust. A $5 coffee shouldn't cost $6 tomorrow. Adoption. Lags, most prefer familiar cash or cards, and tech barriers stump older folks. Governments resist, needing currency control for taxes and policy. They'd push central bank digital currencies instead. Crypto's pseudonymous nature aids crime, spooking regulators. It might coexist, handling niche roles like remittances, but fully replacing fiat needs stability and buy-in. No coins nailed yet. 10. How are cryptocurrency transactions taxed? Taxing cryptocurrency trips up even savvy investors. How do you tax something digital? Is it like stocks, property, or something else? People swap Bitcoin for Ethereum or buy a car with it, then panic. Does Uncle Sam care? Profits seem obvious, but what about losses or tiny trades? Countries differ. Some hit hard, others barely touch it. Do you track every coffee bought with crypto? The IRS and others want their share, but the rules feel murky. This question ties crypto to real-world wallets, as tax bills loom over gains and spark dread in hodlers. Cryptocurrency transactions are taxed based on local laws, often as property in places like the U.S. sell Bitcoin for a profit. It's a capital gain, short-term, over 37% if held under a year, or long-term, 15 to 20% over a year. Losses offset gains, a silver lining. Trading one crypto for another counts too. Calculate the gain in USD at the swap moment. Spending it, e.g. buying a car, triggers tax if its value rose since you got it. The IRS demands records of every trade's cost basis and sale price. Small buys like coffee technically count, but are rarely chased. Other nations vary. Canada's similar, India taxes 30% flat. Track diligently. Audits are rising. Cryptocurrencies. Rise has unleashed a wave of questions, from its core mechanics to its clash with old-school finance. We've tackled what it is, how to buy it, why it's a wild ride, and if it's legal or taxable. Mining, risks, blockchain's role, government bans, and its shot at replacing cash round out the list. Each answer peels back layers of a system. That's equal parts promise and peril. Decentralized freedom meets volatility and red tape. For now, crypto's a bold experiment, not a settled reality. It could reshape money or stay a niche player. Only time will tell. What's clear is the hunger for knowledge. People want in, but they want to understand first. This dive into the top queries shows crypto's not just tech, but a cultural shift, challenging how we see value and trust. Stay curious, stay cautious, and keep learning as this space evolves.